Hello everyone, hope you are having a great week. My name is Drew, the host of Never Behind, wanting to share insights from well-known investors or investors that have been in the market for a long time with plenty of experiences so that they may provide insights of the market that may help you with your personal investments and never be behind the trend. So for those that have been in the market during the first half of 2023, you would have experienced the surprising uptrend of the market and especially the rise in the stock prices in the tech sector. For example, Meta went all the way from under $90 to over $350, and Nvidia went from $110 all the way up to $500 in a very short amount of time. However, during the recent months, especially after the most recent FOMC meeting, the market has started to come down, and a number of investors are worried, questioning whether this is the start of a real market crash or if it is just another pullback that will rebound before the end of the year. Now, we still do have high inflation and very high Fed fund rates, along with regional banks in a very tough situation. And if that is not enough, the UPS strike, UAW strike, and now over 75,000 employees on strike from Kaiser. There's also worries about the possibility of a government shutdown as well. However, on the other hand, there are people saying that the core CPI is coming down and Powell is doing a great job lowering inflation so that they are confident that we will see a soft landing. Now, I guess time will tell since we don't know what the government or Fed may come out with, but let's get some insights from experts that have been in the market and through several market crashes and see what they have in mind about the market we are in right now. Now, before I get into the interview of the expert, I wanted to share that Moomoo is having a great promotion, giving out 16 free stocks including either Tesla or Google. If you open an account now and deposit $100, you get 5 free stocks, and if you deposit $1,000 and just keep that for 60 days in your account, you will get a total of 15 free stocks. And if you deposit $5,000 and keep it for 60 days in your account, you will get 15 free stocks plus either Google or Tesla. So if you want to receive a potential of 16 free stocks, make sure you click the link in the description below.
What's next? We're about to enter Q4 next week. We've had a pretty strong start to the year, but a lot of disruption recently, also some big macro things and some U.S. specific things like a possible government shutdown, other issues here in the U.S.
Yeah, so what's next is earnings season. And as opposed to the last year or so, expectations are higher. They're more optimistic. So now you've got to actually bridge that optimism with reality. I personally think there's a chance it falls short. Look, I think the market, I've been cautious in the market for a number of weeks, remain very cautious on it. I've trimmed exposure. Here's the issue. I do believe we go into recession. I don't believe there'll be a soft landing. I'm still amazed by some of the lunacy out there that as recently as a month or two ago, some strategists, some whatever, money managers are saying the Fed's going to start cutting rates. They're not going to cut rates. They're going to leave rates the way they are. So we've seen a delayed reaction to the massive tightening cycle that we've had. I don't think it gets any better. I think it gets worse. And there are a number of factors. Additionally, inflation is not really under control. Okay, we've had the easy move down from 9% to 3.5%, 4%, pick a number. But guess what? We're poised for it to go higher. Why? Because of energy, because of the UPS strike, because of the UAW strike, because of the Inflation Reduction Act. We haven't even started to deploy capital. Wait till we start doing it. So you've got all the triggers for inflation going higher. So you cannot tolerate rates like that. We're a consumer-driven economy. 2/3 of the economy is driven by consumers. Now you see these cars rolling off leases. So I've had two. Fortunately, I can afford it. But the cost of leasing a car, the cost of buying a car has gone up 20 to 40%. So where do consumers make choices? In addition, you've still seen, while rents may be coming down a little bit in some areas, basically they're still on the rise. So where do you take it from? You got to pay more for energy. Okay, it's not like you've seen grocery prices come down measurably.
Good point.
So it all adds to pressure on the consumer that drives the economy. And guess who's going to pay for the UAW wage increases? You, Bryn, me, Rob. In general, it comes to the consumer.
I really think Steve had great points and insights that he shared during this interview with CNBC. First of all, Steve is saying that so many people are thinking that the storm has gone by and that companies are set for great earnings, although the rates for borrowing money is even higher. He is also saying that there is so much hope and optimism for the next earning calls, where even if the companies come out with an okay number, since the expectations are so high, the market may be disappointed and stocks may plummet since stocks price in expectation and the future of the companies. Now, this is one of Steve's major concerns that he sees happening in the next few months. Now, is he right? Well, we shall know by the end of 2023. Another great point that I agreed with Steve was that he still thinks that inflation is not under control. He's saying that it was a fairly easy down from 9.1% inflation to 4.3%, but this is excluding food and energy prices, which are getting even higher and are the categories that actually hit the average consumers no matter what the Fed says about the core CPI numbers. Now, people will still have to pay for gas and food, which are high. The Fed fund rates are still high, which will impact companies with their earnings that will prevent them from growing, and also have companies come out with higher prices in order to survive. And we are also seeing oil prices going up, along with car leases and car prices going up from 20% to some cases 40%. If this is not enough, we have the UPS strike, UAW strike, and most recently had more than 75,000 people on strike at Kaiser. Now, if the governments leave these strikes go on for a longer period of time, this will hit a number of companies that are partnering with these companies on strike, which then may cause massive layoffs, which eventually reduce consumer spendings since now they don't even have a job to pay for their credit cards, and eventually trigger a recession. So it is highly possible that the government comes out with some sort of stimulus or bill to solve these issues, which then will be deploying more money into the economy and therefore in the short term may raise the inflation rates again. We will have to see what happens in the next FOMC meeting and how the strike settles out, but I do think that what Steve has shared is highly possible and makes sense. Now let's see what Steve thinks is actually happening in the stock market and what he sees happening in the near future, maybe by the end of 2023 or early 2024.
Fed President Susan Collins saying today she feels that we need to keep rates higher for longer. She is a voting member this cycle. So I think you're right. The Fed is just trying to make it clear to the market. Whatever you thought was going to happen, we're trying to make it clear.
Right. So final word. Past is not prologue. Okay. Just because the equity market has held these levels for the top line, lots of stocks have suffered, right? Doesn't mean that's going to continue to be the case. I believe it's a delayed reaction and the markets go lower. They definitely don't go higher and hit new highs.
Now, that was a very short but clear answer where Steve was saying that there will not be a soft landing and a recession will come. And he's also saying that we may be seeing a lag in the economy at this point. Usually the decision made on the Fed fund rates take approximately 6 to 9 months to be applied in the market. So I guess the high Fed fund rates that we are seeing now will start having an impact on the economy and market by the end of 2023 or mid 2024. Now, I just want to make it clear that no matter who says what, you should always do your own due diligence before making any financial decisions because it is your hard-earned money that you are investing. So please do your own research before investing in the market and make sure you know how to protect your assets or learn how to be prepared from a severe market crash if it were to come. So with that, I hope you got some insights out of this interview and hope it may help you with your own investments. Thank you very much for watching, and I look forward to seeing you on the next episode.